Ever wondered how some people, seem to make quick money in real estate without all the usual headaches? No buying, no renovating, certainly no holding properties long term. It sounds almost too good to be true, right? Well, today we're going to dive into something called transactional funding. It sounds technical, but it's this really innovative, pretty flexible financing tool built exactly for those moments when time is critical in real estate.
Yeah, it really is.
So, our mission here is to unpack how it works, what makes it different, and how it manages to create these win-win-win situations. For sellers, buyers, and the private lenders involved, think of it as your shortcut to understanding a really smart strategy.
Definitely. And what's interesting, right, is that transactional funding isn't your typical loan. Not like going to a bank. It's very short term.
Okay.
Often used for really specific things, like covering an earnest money deposit, the EMD, that good faith
I mean, it
deposit.
shows you're serious.
Exactly. The whole idea is speed,
Hmm.
efficiency, hitting those tight deadlines without the weeks or months of waiting you get with conventional loans.
So it sounds like it's about more than just the dollars and cents then. Is there something else that really sets it apart?
Yeah, there is. It's really built around collaboration, building partnerships that actually work for everyone involved.
Hmm. Less rigid.
Much less rigid. We're talking flexible promissory notes, maybe commercial agreements tailored point by point to that specific deal, not some generic bank form.
And what about the people putting up the money, the funders? How are they protected?
Good question. There are solid protections.
Hmm.
Often, they'll secure their interest with a first position lien on the property itself, briefly, or maybe a UCC lien filing against the borrower's business entity.
Okay, what's a UCC lien quickly?
Think of it like a public notice. It basically says, hey, I have a financial claim tied to this borrower's business assets. It gives them security. And crucially, they work hand in hand with the title company to make sure everything's buttoned up, recorded properly.
Got it. So let's get into the practical side. Where does this really shine? Wholesale deals seem like a big one.
Oh, absolutely. That's a classic use case. Imagine you're a funder. You lend the EMD to a wholesaler who's found a great off-market property and put it under contract.
Okay.
Once the wholesaler assigns that contract to an end buyer and the deal closes maybe just days or a week later, you, the funder, get your principal back plus your agreed upon fee or interest.
And you didn't have to swing a hammer or manage tenants.
Exactly. No renovations and no long-term holding. It lets funders cycle their capital quickly, maybe funding several deals at once.
That makes a lot of sense. What about other types of deals? I've heard sub 2 mentioned.
Right, sub 2, that's subject to financing. Basically, a buyer takes over the seller's existing mortgage payments.
How does transactional funding fit there?
Well, let's use an example. Say Ronald wants to sell his house. It's worth maybe 161K, he owes 149K. To sell traditionally, after closing costs, he might actually owe money, say $9,000. He just wants out.
Okay, he's stuck.
Right. Then Alexandra, who's a sub 2 investor, comes along. She says, look, I'll give you $8,000 cash, take over your mortgage payments, you walk away clean. Ronald avoids bringing money to closing.
Okay, better deal for him.
Much better. But Alexandra needs that $8,000 up front. Maybe she only has $3,000. So she partners with Steve, her transactional funder. Steve puts up the other $5,000.
Ah, bridging the gap.
Precisely. Alexandra takes over the property, rents it out for, say, $1,500 a month, easily covering the original $800 mortgage payment. And she agrees to pay Steve back his $5,000 plus interest, maybe like $600 a month for 12 months. Steve gets a fantastic return, like 44% on his $5,000, just for providing that short-term bridge capital.
Wow, okay. That really opens up possibilities. Does it work for seller financing deals too?
It can, yeah.
Yeah.
Similar idea, providing that necessary EMD or maybe some upfront cash to make a seller finance deal work, especially for wholesalers focusing on those types of transactions.
Could you walk us through one more EMD example, just
Yeah.
to really nail it down?
Sure. Let's say Bert has a distressed property. He needs to unload fast for $100,000. Mark, a wholesaler, agrees to buy it.
But Mark doesn't actually want to own it long term.
Right, he wants to assign the contract. But Bert requires a $5,000 EMD to show Mark is serious. Mark doesn't have that liquid.
So he calls a transactional funder.
Exactly. He calls Dennis. Dennis agrees to provide the $5,000 EMD, maybe charging a $2,500 fee for his service, payable at closing. And Dennis makes sure his funds are protected if the deal somehow falls through.
Okay.
Mark uses Dennis's $5,000 for the EMD, locks up the property. Then Mark finds Jackie, a fix and flip investor who does want the property. Mark assigns his purchase contract to Jackie for a $10,000 assignment fee.
So at the closing.
At closing, everything happens at once. Jackie brings her funds. From those funds, the title company pays Bert his $100,000, pays Dennis back his $5,000 EMD, plus his $2,500 fee, so $7,500 total. And Mark walks away with his $10,000 assignment fee minus Dennis's fee, so he nets $7,500.
Wow. Bert sells fast, Mark makes money without owning, Jackie gets her project, and Dennis gets a quick return. That's the win-win-win.
That's precisely it. It greases the wheels of the transaction.
So just to summarize for the funders, how are they typically structuring their returns?
It varies, but common structures are, like we saw, a fixed fee per transaction. Or it could be an interest rate on the money lent, sometimes quite high because it's so short term. Or maybe a percentage of the wholesaler's profit, or even a small slice of equity in certain deals. It really depends on the agreement.
Gotcha. And that speed element really seems to be the key difference compared to, say, traditional house flipping.
Huge difference. Transactional funding is all about velocity, speed, efficiency. Often, the person using the funds, like the wholesaler, might only own the property for minutes or hours, or technically not at all if it's just an assignment.
Right, no hammers involved.
No renovations, no dealing with contractors. You're profiting from finding the deal and connecting the parties, capturing that spread quickly.
Which must lower the risk quite a bit compared to flipping.
Dramatically. Think about it. Holding costs, insurance, taxes, loan payments, they add up fast in a traditional flip that might take 3 to 6 months. With transactional funding, the deal often closes in 1 or 2 weeks. Much less exposure to market shifts or unexpected repair costs.
And I guess the profits you make from these quick turns could then fuel bigger projects.
Absolutely. Many investors use transactional funding profits to build capital for their own traditional buy and hold or fix and flip deals down the road. It's a great way to scale.
So, wrapping this up, it really feels like transactional funding offers this unique mix: speed, flexibility, and this strong element of partnership. It unlocks deals that just wouldn't happen otherwise.
That's a perfect way to put it. It fills a very specific, very important niche.
Which leads to a final thought for you, the listener. Given this really innovative way of using finance focused on speed and collaboration in real estate, what other areas, maybe in business or even other types of finance, might benefit from a similar approach? Where else could that kind of focus unlock hidden value? Something to think about.